What is going on, guys? Nick here, back with another video. In this video, I'm going to take a look at the top 6 most mentioned stocks on WallStreetBets over the last week and try to decide if any of them are worth buying. Make sure you watch all the way through because I'll do a brief recap of the relevant news and I'll also give you my valuation at the end. So the first company on this list is Tesla. Tesla's been on a steady run up since its May lows in the 500s. Infrastructure and electric vehicles are back in focus with significant infrastructure legislation working its way through Congress. The current bill would bring back tax incentives for Tesla buyers to help build out charging infrastructure across the US. Piper Sandler put out a report saying that Tesla is set to deliver its strongest quarter when they report their third quarter earnings towards the end of October, and they expect Tesla to beat its vehicle deliveries forecast by nearly 100,000 vehicles. Now let's take a look at Tesla's revenue and net income over the last 10 years. So we can see a long consistent trend growing their sales, and they generated even more profit than they saw in their first profitable year, 2020. Tesla's balance sheet shows $55 billion in assets to $29 billion in liabilities. This leaves them with about $25 billion in equity. Tesla also reported $11 billion in debt, which puts their debt to equity at about half of their debt. This is a great balance sheet. Tesla is also sitting on a massive $16 billion pile of cash and cash equivalents as of their most recent earnings. When we add in the current analyst forecast going out over the next couple of years, the expectation is for Tesla to continue its rapid growth, hitting $38 billion in revenue by 2023. Looking at their revenue growth, we can see they maintain over 30% growth fairly easily. However, the 2023 forecast shows that slowing to only 22%. From my experience, forecasts are often set low and increase over time, so I think a valuation using a range of 25 to 30% annual growth here is fair. When I put this into my fair PE calculator, Tesla should be priced between 82 to 122 times earnings. If we multiply these ratios by the forecasted earnings, we can see how their valuation changes over time. Right now, Tesla's pretty expensive compared with the trailing earnings, but we can see as earnings quickly rise, this valuation becomes very reasonable over the next couple of years. The current 2023 earnings forecast puts the stock's value between $1,083 to $728 per share. On this chart, today's share price is shown as the orange line. These forecasts are conservative, so I wouldn't be too surprised to see these rise over time. If we look back at the current stock chart, we can see a slight volume bump over the past week, but there's still not as much as we were seeing back in May. The RSI has shown a very steady reading between 50 to the high 60s, and the MACD seems to show volatility is pretty low. We can see that Tesla has shown a golden cross with the 50-day moving average moving above the 200-day moving average, which is a good sign for the stock. Right now we've seen a steady positive trend from Tesla with no obvious signs of it slowing down. I do think that Tesla is a good buy right now, and if there was any dip, I would definitely recommend buying a lot more. Now the next stock is EVGO, and it's not that surprising that it's one of the most popular stocks on WallStreetBets right now with all of the talk about infrastructure spending. EVGO builds fast charging stations for electric vehicles across the US. The company released its first financial results since being listed on the Nasdaq. Unsurprisingly, they saw their highest network throughput as they continue to install fast chargers across the US. They also have a strategic partnership with GM, and they're supposed to be the preferred charging network for GM's Ultium Charge 360. As electric vehicles become more popular in the US, demand for fast charging is only going up. The infrastructure bill currently plans to spend $7.5 billion on charging infrastructure, which is a lot of money, but still probably way short of what's actually needed to build a vast fast charging network. California alone has spent $4 billion on charging infrastructure, and they're still way behind their expected EV charging demand over the next couple of years. EVGO has continued to expand its network across the US. As electric vehicles continue to take over market share from gas-powered vehicles, charging will only become a larger and larger market. This opens up a big opportunity for fast chargers to come in and take market share. Now, when we look at EVGO's income statement, it was a little disappointing. Revenue was actually higher in 2019 than over the past year. Losses are also fairly high compared with the revenue. But keep in mind that this company is in its early stages, so this isn't that unusual. When we add in their forecasted earnings, EVGO is currently forecasted for a big 2.5 years going forward. The current revenue is about $15 million, and that's forecasted to grow to $151 million by 2023. To value EVGO, we have to use a price to sales ratio instead of a price to earnings ratio because they currently aren't turning a profit. I calculate these pretty similarly. The only difference is I take the fair PE value and multiply it by the expected profit margin I have for the company. Now, if you're new to the channel, I have a full video that I'll link at the end that you can check out and figure out how all this works. So for EVGO, I'll use a growth rate range of 30 to 50%, and I'll use a profit margin of 5%. I expect a lot of competition for electric chargers, and since fast charging stations take a lot of cash to build, I don't expect this company to have huge profit margins. This gives us a fair price to sales ratio between 12 and 26 2026. When we look at this on a chart, we can see that based off of this valuation, EVGO is priced just under what I think the stock will be worth by 2023. But these forecasts are guaranteed to change between now and 2023. There is just way too much unknown for anybody to be able to accurately forecast what's going to happen with this company over the next couple of years. What I would pay attention to is if they outperform the current analysts' expectations for them, and then how do these forecasts change going forward. This is definitely a stock to keep your eye on. Now, the third stock on this list is Alibaba. The stock was trading over $300 in November and is now sitting just under $150. The stock has been in a free fall, and if you're still holding, it's been a complete disaster for you. Alibaba is kind of like the Chinese version of Amazon, and unsurprisingly, they're one of the largest retailers and commerce companies in the world. But as I said before, the stock has been in a free fall, with the Chinese government cracking down on their large technology companies, as well as some weak earnings reports. Alibaba was fined $2.8 billion in April for violating anti-monopoly rules after forcing brands into exclusive contracts to gain access to its platform. Recently, Chinese authorities told Ant Group, an affiliate of Alibaba and the owner of the largest digital payment platform, Alipay, that they would have to move its highly profitable loan division into a separate app. They also want Ant Group to give up their user data for a new state-owned credit scoring joint venture. The Chinese government's goal is to reduce some of the power held by big tech companies in China by taking away the control of their collected data. If we look at Alibaba's revenue and net income, we can see the explosive growth we would expect, but the 2021 growth looks more slight than the previous trend. We can also see strong profit margins, especially for a company known as an e-commerce site. Alibaba does a lot more than just e-commerce though. They're involved in cloud computing and digital entertainment as well. The current forecasts expect Alibaba to pull through these difficulties and return to its long-term growth. Revenues are projected to hit record highs of $204 billion by 2024. Baba's revenue growth going forward is projected to slow down to 20%, but if we look at the net income growth, they're currently forecasted to stay over 15% annual growth moving forward. If we account for extra risk and price Baba with a growth rate of only 10% for the bottom number and 20% for the top end number, we end up with a fair PE value between 22 to 54. Looking at this valuation on a chart, this would mean that Alibaba is extremely cheap, with a maximum potential $763 for the top end valuation by the end of the 2024 fiscal year. The low end valuation is still about double the current share price. Now, I don't know when the stock is going to stop falling, but the current price seems very good right now. Eventually, this will change, but it may take a lot of time. So if you currently own the stock or you want to own the stock, it could be painful for now, but if you're patient, this could pay off a lot in the future. But of course, we do want to monitor the news and make sure we're aware of what's going on between them and the Chinese government, because this can obviously have major impacts on their business going forward. Now, the fourth stock on this list is Smile Direct Club. Just before Labor Day, Reddit user Kion posted a huge YOLO on Smile Direct Club. He bought 401 call options on Smile Direct Club set to expire on September 17th at a $6 strike price. In his post, he was up about $164,000 on his call options. This brought a lot of attention on WallStreetBets to the $5 stock. They went from trading around 100 million shares a day to 140 million on September 17th, which saw the stock rise to $7.42 per share. Volume has been down since then, with around 20 million shares traded per day, and the stock has dropped down to the mid $5 range. When we look over at Smile Direct Club's revenue and net income, we can see the company saw a strong rise between 2017 and 2019, with revenues reaching an all-time high of $750 million. Smile Direct Club makes clear aligners at significantly lower prices than Invisalign. You show up to one of their facilities or mail in a bite impression that you make at home, and they create a plan to realign your teeth for sometimes 25% of what it would cost for an Invisalign package. The big difference between them is Smile Direct Club doesn't require in-person consultations where a dentist is looking at your teeth and doing x-rays. And according to Smile Direct Club, only 1% of their customers report issues. However, sometimes those issues can be pretty severe, like your teeth breaking and falling out. Problems that could be avoided if a dentist inspected the teeth and the bone for fractures or any other weaknesses that could cause these issues. Now, there's been a lot of discussion on WallStreetBets about Smile Direct Club as a short squeeze candidate. The public float is around 104 million shares, and the short percentage is pretty high at 33%. The issue is their highest trading volume saw 140 million shares traded, so if the short sellers were forced to buy the stock and cover their losses, plenty of shares would have been available. Short squeezes only occur occur when there's not enough stock available to buy, and those shorting the stock are forced to pay higher and higher prices for them to cover their losses. When trading volume is higher than the public float, it makes it really hard for a short squeeze to happen. But volume has been down over the past couple of weeks, so I'm not saying that it's impossible. Now, if we look at Smile Direct Club's forecasted future revenue and net income, we can see that revenue is projected to grow to just over $1 billion by 2023, about 25% higher than the revenue they took in over the past year. Looking at their future revenue growth, the current expectations are for Smile Direct Club to grow sales by around 15 to 20% growth going forward. Now, Invisalign brings in just under 20% profit margin, but remember Smile Direct Club takes in significantly less per transaction, at about 25% the cost. So I'm going to use a 10% profit margin for Smile Direct Club. If you feel like this number is off, feel free to use my PE calculator in the description and try your own numbers. A growth rate of 15% with a 10% profit margin comes out to a price to sales ratio of 3.5. For our top end estimate at a growth rate of 20% with that 10% profit margin comes out to a 5.5 price to sales ratio. When we look at this valuation charted out, we can see the stock is very cheap compared to the forecasted and even trailing valuation. The top end estimate for 2023 comes in at $15 per share, 3 times higher than the current share price. So I would say that Smile Direct Club is very cheap compared to its current and forecasted earnings. Personally, I'm not that excited about its business model, but I am very interested in a stock that could triple itself over the next 2 to 3 years. Since a single share is only about $5, it could be really interesting to leverage this with long call options. Now, the next stock is Wish, or Context Logic. Wish.com is an e-commerce platform known for extremely low prices. Going on the website right now, I can buy these cool spy sunglasses for only about $6, my own physical Bitcoin for $1.85, and a whole chainsaw for $30. The stock debuted at the end of December 2020 at $20 per share and dropped to 75% since then to only $5.35 per share. The company has struggled as sales have declined. As stay-at-home orders were lifted, they saw their daily user activity and active buyers decline. App installs also dropped, along with the average time spent on the app. Since its IPO, the stock has also missed many analysts' expectations in important areas like monthly active users, so forecasts have declined. When we look at the revenue versus net income, we can see the company has shown pretty steady growth at nearly $3 billion in revenue in the last year. But we can also see that net income has taken a huge hit. When we look at the revenue versus expenses, we can see that sales and marketing is their largest expense, and over the last year they took in $2.8 billion in revenue and spent $1.7 billion on sales and marketing. Since 2018, Wish has grown total revenue by 63%, but the cost of revenue is up over 300%, and product development and general and administrative costs are both up over 500%. Now, going into their forecasted revenue and net income, the current forecast doesn't look great. Revenue is projected to dip over the next 2 years and return to this year's revenue levels by 2023. They also expect earnings to get close to break even by this point. Now, I think Wish is a little tough to value since we don't have any growth projection going forward. In this case, I think it would be best to first estimate a profit margin. I'll use a conservative 5% and then see how that compares with the price to sales ratio. Context Logic's market cap is currently $3.36 billion, meaning if you took every share and added them up at the current share price, how much the whole company is worth. Over the past year, they brought in $2.8 billion. This would mean the company is trading at a price to sales ratio of 1.2. When put into my new price to sales reverser calculator, this comes out to a growth rate of 10%. Going forward to the end of 2021 and 2022, analysts project $2.8 billion in revenue, and this comes out to a price to sales ratio of 1.5. Putting this into the price to sales calculator, it comes out to a forward growth rate of 13%. 2022 projects the same $2.8 billion as the last year, which comes back to a growth rate of 10%. Now, while these aren't incredibly high projections, the company is currently forecasted to have flat growth over the next couple of years. And I'm also not that sold on their business model. There might be some great deals for some products out there, but the quality of these products are generally pretty bad. And people seem to be pretty aware of these product quality issues, and if they aren't aware, they're probably not that likely to become a repeat customer once they get the product in their hands. And to me, this makes sense why there's a decrease in their customer base. Okay, so the last but not least company is Palantir. So they debuted in October 2020 with a share price around around $8. The stock has had a lot of volatility, going as high as $37 before coming all the way back down to $17. It currently trades at $24. They're a big data analytics company working on government and corporate contracts, doing all kinds of things like tracing COVID-19 infections, tracking medical supply chains, and its technology was even used to locate Osama bin Laden in 2011. They do deep analysis of petabytes worth of data. Even though this company has been around since 2003, they only went public a year ago, so we have limited information about its revenue and net income. But looking at the data that we have from 2018 to the last year, we can see pretty steady growth, but we have seen losses equal to their revenue growth. When we look at their revenue versus expenses, it seems like all of their costs are split between all of their expense categories, so there isn't just one expense driving their losses. When we look at their forecasted earnings, analysts, and keep in mind that there's only 7 of these, project Palantir to turn profitable by the end of this year and continue to grow revenue and earnings going forward. But I am a little skeptical of this, especially because analysts have been moving away from recommending buying the stock. To me, the forecasts just seem a little too good to be true. But even so, let's take a look at what the stock should be worth. So the current forecasts see the revenue growth going at over 25% going forward. I'll use this as my top end forecast number, and because I'm still a little skeptical of the forecasts, I'll use a growth rate of 20% for my low end estimate. So a 20% growth rate translates to a PE of 55, and our top end number, 25%, translates to a PE of 82. When we look at this valuation on the chart, we can see that even with the forecasted earnings going forward, the stock is pretty expensive, with it trading above the highest multiple for the 2023 earnings. Now, this doesn't mean that it's all bad for Palantir. It just means in the near term, I'm not that confident about buying it at today's price. I actually think that as an options play, the company has a lot of value. With all of the volatility and all of the volume, there is a lot of opportunity to make money off this company with options if you can guess the volatility correctly. Alright, so I recommend, if you are interested in buying any of the stocks that I just mentioned, to spend some time reading about them and learning a little bit more about them before you buy. Make sure you look a little more into their finances so you really understand what it is that you're buying, and also comment below which one of these companies that you guys like best below. Also, feel free to play around with my PE calculator that I have linked in the description below, and if you want to learn a little bit more about how I value stocks this way, click the card. It's one of these corners, I'm not sure which one. And as always, thanks for watching.